If you've been an investor over the past couple of years, you're probably familiar with one of the following terms.
Responsible, sustainable, or green investing.
ESG investment.
Everybody seems to be talking about responsible investing these days.
And you may be confused. What does it mean? Why are there so many acronyms? And why is Elon Musk so angry about this thing called ESG? In this video, we want to put some of these questions to rest, because investing in line with your morals can be an important way to make good use of your money. Stick around to the end of the video to find out why Elon is actually so outspoken on this topic. So, ESG, SRIF, impact. Don't worry too much about the confusion. Even some of the most seasoned investors struggle to define exactly what these different terms mean. For now, let's define ethical investing as a way to invest that considers both financial returns and the environmental, social, and ethical consequences of companies' actions. At its core, ethical investing is about investing with a conscience and using your moral compass to direct your money. Now, there's a few ways to achieve this. Let's cover three right now. One way to invest ethically is to use a negative screening framework. These sorts of frameworks date back to the origins of ethical investing. In the 1840s, a Christian organization known as the Quakers prohibited their members from participating in the slave trade. Later, in the early 1900s, the Methodist Church issued more detailed investment guidance that was consistent with their belief systems. This sort of removal is usually a process of selecting which companies are engaged in unethical activities based on their financial and corporate company information. These companies are then screened out of potential holdings. Some of the most screened companies include sin stocks. These are companies such as tobacco giants, gambling companies, or alcohol producers. By removing these sorts of companies, ethical investors can sleep soundly knowing that they're not invested in behaviors that they would consider unethical. Another investing framework is called positive screening. This framework allows investors to search for companies with positive ethical attributes, like low carbon emissions or active investment in the community. Alternatively, you might choose to only invest in companies that have a diverse board of directors. The companies that pass through these positive screens are then deemed investable. Another way to invest ethically is impact investing. This involves investing specifically in companies that are making a direct positive impact on the environment or on society. This means you hold companies addressing the world's most pressing challenges in sectors like sustainable agriculture, renewable energy, and healthcare. Investing in, say, a company that generates solar energy means that you have a stake in clean energy generation through ownership in the stock. You own a piece of the future. That's pretty cool. That covers some of the biggest ways to invest ethically or sustainably. Now, it doesn't necessarily have to be costing you in order to invest in this way. A common question we get around ethical investment is whether or not it will hurt stock returns. The answer is basically no. Intuitively, there's a few reasons why ethical companies can perform well financially. Usually, companies that have poor ethical standards risk reputational damage, high employee turnover, and in some cases, high risk of fines from breaking the law. Additionally, companies that operate in certain unsustainable sectors, like coal mining or oil and gas refinement, often have larger risk of something called stranded assets. These are investments that risk becoming worth less over time, like oil and gas reserves that may not be refined and used if the shift towards green energy continues. Theoretically, companies deemed unethical are more likely to face controversy and the devaluation of assets compared to companies deemed more ethical. These things can both negatively impact share price, and the data backs it up. Long-term studies have shown that on average, responsible investing can return in line and in some cases more than conventional investing. Let me give you an example. BetaShares offers two global investment products. The first is our Global Shares ETF with the code BGBL. The second is our Global Sustainability Leaders ETF with the code ETHI. Both ETFs give global exposure, excluding the Australian share market, and both ETFs have similar geographical and sector breakdowns. The key difference is that ETHI uses a series of positive and negative screens in order to arrive at a fund composing of companies identified as sustainability leaders. Let's compare the performance of these two different indices. ETHI's index has actually outperformed BGBL's index over an 11-year time horizon. Over that period, Ethy's index returned 19% every year, whereas BGBL's index returned 15% annually. This gives the Ethical Investment Index outperformance of 4% per annum over the period. We see that in this instance, investing ethically doesn't have to hurt your returns. Now, it's not always guaranteed that ethical investing is going to outperform other conventional ways of investing, but that doesn't mean you can't make money while feeling good about your investments. Aside from the potential performance benefits, why would you want to invest ethically? Again, ethical investment is an opportunity for you to align your personal moral compass and where you put your money. If you believe that the world should transition to renewable energy and stop relying on fossil fuels, you can invest in clean energy solutions like solar and wind, and you can avoid investment in companies with large carbon emissions. Or, if you only purchase ethically sourced clothing, you can invest in brands that use sustainable fibers and pay their employees fair wages. The beauty of ethical investing is that you decide how you should invest. You have the freedom to use your money the way that you want. Of course, this creates some difficulty as well, because everyone has a unique set of moral codes and principles. Everyone has a different idea of what ethical investment looks like. So I could look at an ETF and say that it's ethical to invest in, whereas you could look at that same ETF and say it's full of unethical companies. This difficulty was highlighted earlier this year when a financial rating agency, S&P Global, gave Tesla, the world's largest manufacturer of electric cars, a lower environmental, social, and governance score than Philip Morris International, the maker of Marlboro cigarettes. This was followed by a lot of outrage in the financial community, and of course outrage from Elon Musk. Things like this happen because different people have different ethical standards. This brings us to the topic of greenwashing. Greenwashing is misrepresenting the extent to which a financial product or investment strategy is environmentally friendly, sustainable, or ethical. It's easy for investment managers to slap a label on a product and say that it's ethical because the term is now so broad. Because of this, ethical investors need to be on their guard. You can always check the holdings of an investment fund or ETF on the fund webpage to check to see if it holds any companies that don't match your ethical goals. For many ETFs, there's an investment methodology that outlines how companies are selected, giving you the lowdown on what exactly is included or excluded from different holdings. Finding out if a company is in line with your ethical views is a little more challenging. You can read company annual reports to learn more about their activities. Publicly listed companies will have these reports available, usually on their website. For example, here is the annual report and ESG section for Woolworths. But it's always important to keep a lookout for which companies might be inflating their ethical credentials and which are telling the truth. To do that more effectively, check out the Insights post we wrote linked in the description, highlighting 5 guidelines to avoid surprises in your ethical ETFs. But for now, that's the basics of ethical investing. Thanks for watching.